afternoon, everybody. Welcome back to Strongman Personal Finance. We got to cover the earnings for Q2 for Meta, my mother effing Jetta. I told you to buy this stock when it was $75. I'm just kidding. But let's go ahead and see why the stock is up 6% today. The earnings must be amazing. So, the first quote is from the CEO, Zuck the you-know-what. We have a strong quarter, and Meta AI is on track to be the most used AI assistant in the world. Full stop. The AI thing that is on Facebook is one of the most annoying freaking things on the planet. I'm dead serious. I go on my app, and I try to search somebody because, I want to stalk somebody and just see what they're up to. And I get this, AI thing that pops up, and then it searches, and it gives me these, weird answers. I just want to look up somebody. The Meta AI, it's a joke, in my personal opinion. I could be totally wrong. But for me, it's been an annoyance. I haven't used it. The only time I've used it is on accident. Maybe there's more features to the AI that he's talking about. My experience with it has been freaking annoying. So I'll leave that at that. So Meta's going to zero, okay? We've released the first frontier-level open-source AI model, you and every other company in the world. We continue to see good traction with our Ray-Ban Meta AI glasses. Yeah, I want freaking AI glasses. And we're driving good growth across our apps. So, revenue by revenue is up 20%, 22% year over year. That's pretty incredible revenue growth considering the fact that this is one of the largest companies in the world. Okay, you would see this kind of revenue growth with, small caps, basically. I think it's even outstripping Palantir, isn't it? Costs and expenses are only up 7%. So if your revenue grows faster than your expenses, guess what? Your income from operations explodes even faster. Their income from operations is up 58% with a 38% operating margin. I believe that is in line with their operating margin prior to the pandemic Okay. Actually, a little bit lower than during the pandemic. We could see during the pandemic, it was in maybe the low 40s. But that was a special time in the world, okay, where free money was just sloshing around. Everybody had money to throw at garbage. Let's see. Income tax is only up 9%. Net income up 73%. And diluted earnings per share up 73%. This is what's driving the stock price. Let's go look at earnings per share and free cash flow per share. So remember back in 2020 when or 2022 when the stock dropped massively? This is why. Look at before the pandemic, 2019, we had an increase in the stock's earnings per share during the pandemic, and then we hit 2022, the almost recession happens, and we hit an earnings per share low in the third quarter of 2022. Then Meta My Jetta recovers, and now earnings per share is as high as it's ever been. Okay, this is what happens when you grow profits and buy back a bunch of shares. That's why the stock price dipped massively and why it's back up. Was it inevitable that EPS would recover? Maybe, but there was a legitimate reason the stock price was crashing. But EPS is up, so it's not just a bubble that the stock is going up. There's a reason it's happening. But it's not from AI. It's from their core business. Okay, I don't think they're making any money off freaking AI. They're losing money hand over fist from their reality labs. I guess we'll see that in a second. But this is the core business recovering from the almost recession and for their huge investments that they made in that garbage. Here's the free cash flow per share. Can you see why the stock plunged massively? Okay, this is why. So let's read some of the highlights here. Family of daily active people. Okay, this is all their different freaking apps that they have. Facebook, Instagram, whatever. Instagram is cancer. Daily active people was 3.27 billion on average for June 22 to 24, an increase of 7% year over year. So the global population is 8 billion. Facebook can definitely, in the long run, reach almost all of those people because there's really not a competitor, I think, a social media competitor to Facebook. Instagram, okay, there's some competition out there. TikTok, big block. But when it comes to an actual social media platform where you can advertise to people and where you can upload pictures and communicate and message people, it's really only Facebook. I can't really think of one unless there's some weirdo one, in other countries around the world that's only used in specific countries. But this is a global company, obviously. And we can see that it's still growing users year over year at a clip that's higher than inflation. So if you can grow your users and you can squeeze more money out of the advertisers, guess what? You can really keep growing your revenue. Ad impressions delivered across our family of apps increased 10% year over year. Yes, my mom told me that. She keeps seeing more ads. Average price per ad increased 10%. So they're showing more ads and they're charging more per ads. That's why you see revenue growth. Okay. Total revenue was an increase of 22%. On a constant currency basis, would have increased 23% year over year. Total costs and expenses were $24.22 billion, an increase of 7% year over year. Capital expenditures were $8.47, including principal payments on finance leases. Capital return program. Share repurchases were $6.32 billion of our Class A common stock, and dividend payments were $1.27 billion. Okay, I'm happier that they're buying back shares. Dividends are dividends. It takes cash off the balance sheet and it gives it to the shareholder. And the stock price drops by the amount of the dividend. How many times do I have to say this? Cash equivalents, and marketable securities were $58 billion. I'm sure Facebook's going bankrupt next month. Free cash flow was $10 billion. Okay. Always remember, always check the free cash flow per share and earnings per share, because that's what ultimately matters to you as the shareholder. The whole company could have growing free cash flow, but if their share count grows faster than their free cash flow or their earnings, then you get less of the future profits of the business. So I would look at, instead of looking at just free cash flow, I would look at it per share like we did. And of course, they fired 1% of their staff. Amazing. I'm sure there's a bunch of slugs just hanging around. We expect third quarter 2024 total revenue to be in the range of $38.5 to $41 billion. So on the low end, let's see, what was their Q3 revenue last year? So they're going, on the low end, it's 38.5. Let's do the math here. 38.5 divided by 34.1. They're looking at a minimum of 13% revenue growth year over year. For the third quarter, this is looking forward. And on the high end, they're looking at 41 divided by 34.1. 41 divided by 30. 41 divided by 34.1. They're looking on the high end, 20%. Now, if they beat revenue, we're going to look at 22% more growth year over year. Okay? So, they're guiding for pretty good revenue growth. We expect full year, this is so weird how they do this. Our total expenses will be 96 to 99 billion. Okay, thank you very much. Give us like profit projections. For Reality Labs, we continue to expect 2024 operating losses to increase meaningfully year over year due to our ongoing product. They are dumping so much money into this freaking thing. Okay. Okay, let's see. Okay, they're talking about how infrastructure costs will be a significant driver of expense, because right now they're doing a bunch of capital expenditures. They're investing in property, plant, equipment, et cetera, research. Over time, the cash flow goes out first, but the expense gets recognized over the useful life of whatever they purchased. So you'll see cash outflow first, followed by expense on the income statement. This is what they're talking about here. We anticipate our full year 2024 capital expenditures will be in the range of 37 to 40 billion. So let's compare that to last year. Annual, let's see, capital expenditures for the full year, December 31st, 2023, was 27 billion. So they spent 27 billion last year, and they're spending 35 to 40 billion. God, oh man. I mean, it could pay off. I don't know. While we continue, we currently expect, okay, yeah, so they're dumping more and more money into AI. But even then, they're still growing free cash flow per share. It's pretty crazy how well they're doing. But it's Facebook, my Facebook. Okay, let's go look at the financial statements. Let's see. So, we looked at their revenue. Revenue's up 22%, we know that. Research and development is up roughly, 12%? Let's do 10.5 divided by 9.3. 13%. No surprise there. They're dumping more money into R&D. That's something that gets paid off. That pays off in the future. Marketing and sales is down, and general and admin. So they increase spending on stuff that matters, research and development, and they cut marketing and sales expenses in general and admin. They basically fired a bunch of people. Okay. Income from operations is up massively. They have interest income, net interest income, probably because of stuff on their balance sheet. Taxes really didn't grow that much, and overall net income didn't quite double, but we see massive increases in diluted and basic earnings per share. Okay. On top of that, we see drops in share counts, obviously because they're buying back shares. The funny thing is, weighted average shares used to compute earnings. So the their diluted shares outstanding is actually not really down significantly year over year. That's funny. So there's some kind of, I don't know, convertible security or stock options probably that's bumping up the diluted earnings per share. All right, let's look at the balance sheet. So liquid capital is roughly let's see, 32. Let's do the math here. So their liquid cash or cash equivalents on hand, stuff that's going to be converted to cash very quickly, is the sum of the cash and cash equivalents, the marketable securities, and the accounts receivable. Total of $72.5 billion of very liquid cash or cash equivalents on the balance sheet, compared to current debts of $27 billion. Their total liabilities are $73 billion. So they could literally take all their cash, marketable securities, and accounts receivable, convert those to cash if they need to, and then just pay off all their debts if they really had to. But obviously they're not going to do that because they're using this cash to buy back shares. You can see the cash drop pretty significantly because they're buying back shares and paying dividends. Okay, marketable securities went up a little bit. That's just moving cash from cash to marketable securities to get a little bit more interest yield. AR is down. That could just be a timing issue. Prepaid expenses, whatever. Okay, let's look at, so we see property, plant, equipment. So they're definitely investing more money into property, plant, equipment, buildings, whatever. And you can see over what they're saying is over time they're going to have to expense this out, and that's going to affect profit and loss. That's what happens. Cash goes out first, the expense follows. Operating leases, okay, they have some leases, no crazy growth there. No change in goodwill, so no impairments for acquisitions. And other assets, whatever that is up, a couple, $2 billion, $2.5 billion. All right, long-term debt, let's see. Okay, they have $18 billion of long-term debt. They could literally pay that off instantaneously if they wanted to, so that's really irrelevant. Long-term income taxes. So this is taxes they're predicting they're going to have to pay, but that's always subject to changes in the tax code. And other liabilities, I don't know what that is. Okay, common stock and additional paid-in capital. So they're issuing stock. Why? Probably stock options. Employees get to exercise their stock options, and the company then takes the cash from their profits, and they use that cash to buy back the stock, and it's basically another form of employee compensation. Okay, accumulated other comprehensive loss, immaterial, 500 million up, it looks like. And retained earnings down a little bit. Now you're like, retained earnings goes down. Usually profits increases that. Well, it gets decreased by share retirements, and it gets decreased by dividends paid. That's why retained earnings is down, even though Meta's posting profits. So we have a reconciliation of cash flow, net income to cash flow. So we see cash flow from operations is up roughly $2 billion for the 3 months ended June 30th, year over year. Let's see if there's any changes here. And the funny thing is, so there was a timing difference for accrued expenses. So for the same quarter last year, basically they incurred a bunch of expenses but didn't pay the cash yet. So they added it back. Here they had a subtraction. So if this same timing difference had happened in the current quarter, their cash from operations would be about, $4.5 billion higher. Or no, actually, $5.7 billion higher. They would have had way more cash from operations, but this timing difference for accrued expenses obviously changed that. So, you over time that evens out. It's just a timing difference for balance sheet items, but that's something to really be noted. Is that's what caused the not quite big increase in cash flows from operations, it looks like. Yeah, I don't really see anything crazy on here. Okay, let's see what they're doing. So they've increased their purchases of property, plant, and equipment by 33% roughly. They've purchased some marketable securities, some of them mature. This is just them parking cash. Very tiny acquisitions of businesses and intangible assets and other investing activities. So the big thing takeaway is that they've increased their investments in property, plant, equipment by roughly 33% from the prior quarter of the prior year. All right, taxes paid. So look how much they're paying in cash. Taxes paid related to net share settlement of equity awards. So this is basically like they're paying taxes for the employee stock options that are being exercised. Okay, $3.2 billion. That's double the amount. Employees are cashing out those stock options, and you can see why. They spent $6.3 billion buying back shares. So if you think about it, a big chunk of this $6.3 billion is just paying the employees, because the employees are getting shares for a discount, and you, as the shareholder, part of your free cash flow is used to compensate those employees. But whatever. Dividend payments, $1.26 billion. Great. I love dividends. Proceeds from the issuance of okay, they didn't take on any additional debt. They didn't really pay it off either, but that's not a big deal. Like I said, they could pay it off with cash. So overall, really nothing bad to say. Let's see if they have Reality Labs. Okay. Let's see. Income and loss from operations. It's still like their investments in Reality Labs and AI. It's still like immaterial. It's nothing. Okay. This is still the Facebook of old. That's all it is. The family of apps income from operations is 19.3 billion, and they lost more on Reality Labs. Hopefully it pays off for them. We'll see. But you can see the loss from Reality Labs was $4.5 billion. Okay. So that's Meta's earnings. I mean, what are you going to say? It's what percentage of my portfolio is this? ET's down. Oh no. 1.32%. I'm a genius by my course. All right, that's my video. Don't forget to hit like and subscribe. If you want to sponsor videos, send me $50 to the pinned comment below. If you want to buy my book, Stop Being a Broke Loser, it's on Amazon. And if you want a one-on-one tutoring session to learn accounting, because I'm a genius and a CPA, it'll be $75 an hour. See the pinned comment below. Talk to you later. Cheers.